Welcome to Boss Talk. My name is Jim Parker. This is my business partner, Carey Sobel.
Today's episode is SBA and the sale of your business. SBA stands for the Small Business Administration, and it's one of the most common ways that small and medium-sized businesses are sold. And in 2024, there were approximately $37.8 billion of loans. And while I don't know the data for 2025, I'd assume it also went up. 24 was an increase year. And, you know, it's a fascinating product. I think a lot of people don't know about it, and they should. And there's no better person to speak about that than our guest today, Lynne Singletary.
Thank you.
We've been working with Lynne probably 12, 13, 14 years.
Yes.
Yeah. And Lynne is with 44 Business Capital, which is a division of Beacon Bank.
Correct.
And Lynne, I would love for you to introduce yourself and tell us a little bit about you.
Sure. So Lynne Singletary, as Carey said, with 44 Business Capital, we're the division of Beacon Bank. Beacon Bank is a New England bank. So they have a footprint in New England, but outside of that, we can make SBA loans throughout the U.S. I've been in SBA-focused lending for over 30 years. Started years ago with the money store. And back then, there might have been 3 or 4 SBA lenders. Banks didn't even really know how to spell SBA, much less do it.
Yep.
And so we were basically rocking and rolling with SBA, trying to introduce SBA to folks like yourselves, because you guys didn't know that that product was out there and how beneficial it would be for business transactions. And really, when I started, that's the majority of what I did was financing business acquisitions. And then all of a sudden, it just kind of blew up. Banks opened up their eyes, said this might be a great thing. They started buying the non-bank lenders, and here we are today. Most banks are offering it.
Lynne, I'm so happy you're here because most businesses are going to sell between $750,000, $2 million, between that mark, $750,000, $2 million. Almost all of them are SBA lending. I mean, you can do them for less, you can do them for more, but that $750,000 to $2 million, if you're a business owner out there and you're thinking about selling, you need to listen to this podcast, because if your business is going to sell between that mark, it's going to probably be an SBA loan.
Either that or you're going to sell or finance it.
Or you're going to sell it. You don't want to do that.
No, I mean, you've got a lot of goodwill. There's a lot of times you're not selling a business with real estate. And even if you are, the majority of it might be goodwill. And banks, the typical bank doing a conventional loan really is looking for collateral. So and there's not a lot, right? There's a lot of goodwill, blue sky. So with the SBA product, we have a credit enhancement from getting the 75% SBA guarantee. So that enables lenders to kind of open up their box a little and say, okay, we can be a little bit more flexible on our terms. Through SBA, you are not allowed to decline a loan just based on not having sufficient collateral. So we're cash flow lenders. If the cash flow is there, you're not supposed to be looking at collateral. Of course, you'll take collateral if it's there, but if it's not, that's not a reason to decline the loan. So that's the difference between a conventional loan and an SBA loan, is we're able to open up that box and make it a little more flexible.
Excellent.
And I have written down that there's 1,800 SBA lending partners nationwide. Of course, it may be higher or lower. So SBA 101, what actually is the SBA loan product, and what makes a lender a SBA lender? How do you become one?
Many people have the misconception that the SBA financing is actually coming from the government, that the government is making the loan.
Maybe we could start right there. The SBA, the Small Business Administration, is a government agency.
Exactly.
And then go ahead.
So it was created in the 1950s. I think Eisenhower was the president, because they found that small businesses weren't being underserved by the banking community. So they started the SBA. Back then, they did make, the government actually made the loans. And then that, of course, became, not
I never
sustainable.
Knew that. Neither did I.
And so they went to the banks and they said, okay, we'll give you guys a guarantee. We'll give you a credit enhancement if you will step out there and make these loans.
So basically, if they follow, if the bank follows all the guidelines that the SBA lays out, and there's default on the loan, the government guarantees 75% of that loan.
Exactly. So the SBA has what's called the SOP, Standard Operating Procedures. all lenders who are doing SBA loans or making SBA loans, that's our Bible. That, that's the guideline that they give you. Now, the SBA says, here are your guidelines. But then you've got the lenders too. So the lenders come in, banks come in and they say, okay, well, we see that, but we're a little bit nervous about being that flexible. Yeah. So we're going to kind of overlay our credit on there. So at minimum, you have to meet the SBA guidelines, but there are certain hot buttons that certain banks may have. And they're, they just may,
they can
may
build
be
criteria.
Eligible, but they just may not do it, that particular bank. But then another bank may. So banks can make SBA loans. You have to submit several loans to the SBA under what they call general processing, just so the SBA knows that you know what you're doing. They have certain criteria that you have to meet, where you have to have your own servicing. There's certain servicing criteria and all of that. As long as the bank meets that, then you are eligible to. I think you have to make application to the SBA to be able to make an SBA loan, but banks will do that. There's non-bank lenders who have to get an SBA license. I think there's like 13 or 14 licenses out there. There's not too many non-SBA lenders anymore. There used to be, like I said, a lot more.
I was going to say, what would make a bank not want to offer the SBA product?
It's expensive. It's time consuming. Most of the best SBA groups are the ones that have separate, like we're 44 Business Capital. That's all we do, but we're a division of Beacon Bank. So we've got our own originators like myself. We've got our own underwriters, our own processors, closers, and servicers. That's all we do in our division. That's expensive for a bank to have that separated out of their business banking or, commercial group. So it's expensive. Some of them just don't want to deal with it. It's a different product. You have to know what you're doing. So I think most banks dabble in it, for CRA purposes. But then there are most of the kind of middle market banks, the regional banks, find it more beneficial just from a fee income, servicing income type of thing, where you've got the larger banks, the Chase, the Wells, the national banks, that they're making their money through other avenues like trust relationships and things like that.
Cool. I just want to say something too while we're talking, because we're talking about, the SBA, if the banks follow those guidelines that they guarantee the loan up to 75% of the loan if there was default on it. And I know you might be listening out there and going, that's crazy. Why is our government getting involved with that? I want to mention a couple things about that. One is that I have broker friends up in Canada, and there is no SBA. Even outside of the acquisition of acquiring a business, SBA is a fantastic engine in this country. Mm-hmm. It has helped small businesses in this country. That is why we have such a great business community in this country. And the other thing is that the SBA is one of the few government programs that actually generates money. So it's a great program.
Yeah, that's true. We're self-sustainable. So there are SBA guarantee fees that are charged on every loan. Some would say that they're fairly substantial because they're more than what a conventional lender might charge 1% for. But those fees go to the SBA, and that's what supports the SBA program. So
in case there's a default or something like that.
Right. So basically the program pays for itself through those SBA fees. And that's why every year they kind of go up or down. So it just depends. If there's been a lot of defaults, then those fees are probably going to go up because they need to,
it's just
make
math.
up for those. Yeah, exactly.
As I understand it, I'm not sure if all SBA products roll up to the two, but there's an SBA 7A loan, there's an SBA 504 loan.
Correct.
Do you want to talk about the differences, and are there any others besides those?
There are some other ones that we don't ever get involved in. So the main for business owners and for business brokers such as yourself is the 7A and the 504. The 7A is a much more flexible program. So the 7A, you can finance business acquisitions, you can finance equipment, you can finance buildings, working capital, business expansions. It's much more flexible. The 504 is really asset driven. So purchasing a building, purchasing large equipment, you could use the 504. Typically on a business acquisition, we're using the 7A.
Yep.
Because even if there's real estate, we can incorporate it all into one loan. And especially if the real estate is a higher value than the goodwill, the whole loan gets a 25-year amortization versus 10 if you're just doing a business acquisition with no real estate. You've got a 10-year amortization.
And that can be incredibly advantageous. Yeah. I mean, if you think about a buyer buying a business that is a 7A, just the business, there's no real estate included, it's going to be a typical 10-year amortization, meaning you have 10 years of amortized payments to pay the loan. But when you loop in the real estate, the business value also has that 25-year period. So it lowers the actual principal and interest payments on the business aspect of it.
Exactly. And also the benefit of the 7A and the 504, but basically the SBA loans or financing is that the business owner or whoever's buying the business really can, the requirement is a 10% cash injection, right? But if you go to a conventional lender, they're going to be looking for 20, 30 on business acquisition.
And more collateral.
And more collateral. So the benefit to the SBA programs is really the outlay to the business owner to get that financing is much more advantageous, which means they keep their money in their business working in their working capital versus tying it up in a building or equipment.
And for a seller, I mean, the great thing for a seller is now you're putting your business out there in the market. And if it qualifies for an SBA loan, you're looking at, and you're finding buyers. A buyer only needs to put 10% down on the loan, and the seller is going to be paid out on the day of close. If they're not carrying any kind of owner financing or anything else that is negotiated between the buyer and the seller, but typically the seller is getting paid out on the day of close, and the buyer only has to put up 10%. And even if the buyer has the money to buy the business in full with cash, they don't. Buyers want to leverage. No, people, I have never sold a business for $1 million, $2 million, $3 million where, to an individual that paid for it in cash. Right. They're going to leverage their money.
Sure. It makes sense.
And from our standpoint and to the seller's benefit, if you're advertising a $4 million business without financing, if you're not doing seller financing, you're looking for a cash buyer that has $4 million. If we're bringing that business to market that's pre-qualified for SBA financing, that buyer can come to the table with $400,000.
Yeah.
That is a huge swing that opens up the pool of buyers that are able to actually acquire a business. That's kind of the concept between SBA, behind SBA, stimulating the small business market in the United States. So,
and what's fantastic, I mean, this, you look at it. So if you're a buyer out there and you're looking to buy a business, and let's say you have $300,000 in cash, usually the lenders don't lend on an SBA loan for $300,000 for a 7A for an acquisition, because it's too much work. It would cost too much. It's cost prohibitive usually, anything less than 300. So you got a buyer that's got $300,000 to buy a business. They can buy a business for $300,000 in cash, and they're probably going to make, $125,000 a year from that business, or they can take that same $300,000, buy a business for $2.5 million, $3 million with a 10% down. Now they're buying a much bigger business that has much better infrastructure. That's more of a business that even after they pay the loan off every month and pay their loan payments off every month, they're making a lot more money bottom line than they would be buying that business for $300,000. So just from a buyer's perspective, when they're looking to acquire a business and they have that $300,000, it makes more sense to buy a much bigger business than it does to buy a smaller business. They
don't realize the power that's in their hands with this tool.
Exactly. And SBA is fantastic.
It is. So speaking of it, let's attack two questions at once. Who's involved in an SBA transaction, and how does a deal get approved to be qualified for SBA financing?
So we can look at pre-qualifying a business. So you guys are looking at selling a business. You get the financials, you look at it and you go, yeah, I think this is going to, probably will fit SBA. You can go to an SBA lender that offers that service. Not everybody does. And say, okay, I've got this. Would it qualify for SBA? And so we'll give basically a pre-qualification to you so that you can go out and market that business and say, okay, there's a chance that you can get SBA financing. So that's one. Then you've got the buyer that comes in and, now you need to see, okay, I've got this business. It's been pre-qualified as an SBA loan. What about this buyer? Will that buyer work? And so each lender again has their own qualifications for buyers, but we look for past experience of the buyer, translatable experience. You don't want a brain surgeon buying a
restaurant.
Yeah, a restaurant, right? Or a auto shop or something, unless there's extenuating circumstances. So, we've got to mirror those two together and say, okay, this would work. And then you guys do your magic and, get a contract going, and then we look at financing it. So business owners, it's a benefit because they're going to be able to sell their business.
You open up the buyer pool greatly by this program. Yep, go ahead.
Exactly. And then the buyers, they're out there and they are able to buy these businesses. Again, like you said, you can take your cash that you've got and really buy a much larger business through the SBA program.
And essentially, when a business is pre-qualified for SBA financing, it's not a one size fits all for every buyer, like you said, right? So it's pre-qualified, meaning it's a business that can be lended on.
Yes.
But for a buyer, if they are not going to meet the qualifications, it's not the case. So you have a buyer and a seller that are involved in the transaction. You have the bank that's ultimately floating the cash to do it. And you have the SBA, which is where most people don't understand what their role is, but they are essentially insuring the bank. They're guaranteeing the bank.
Right.
So you really have those components that are involved in getting a transaction done.
Yes. Now, when you're an SBA lender and you are you've been given the status of a PLP, preferred
lending partner,
preferred lending partner, we've been given the credit authority by SBA to make the credit decision. We submit very limited information to the SBA. Within 24 hours, we get an SBA number. That means, okay, now you've got that guarantee. We don't have to. PLP lenders do not send the loans to SBA for their credit analysis. Unlike that's a 7A. The 504, they still have to do that. So most lenders that are doing any kind of volume in SBA are preferred lenders. And so that's another misconception, that a lender has to send the loan to SBA and that SBA actually has to approve it. And that's not the case for the 7A if you're working with a preferred lender. And most lenders are.
I recently closed on a transaction where the buyer, against my advice, chose a SBA lender that was not a PLP.
Oh, yeah.
And I'll tell you, first of all, they had to submit everything for the SBA. It felt like it took forever to get the okay and get the thumbs up. But even beyond that, beyond the time that it took, the whole process was so much more difficult because of what you said. Most lenders that do volume, or this is their mainstay of their business, they're going to be PLP.
Yes.
This situation, that person, this wasn't something that they do very often. Yeah. And it made for a lot of heartaches, problems, things like that, it just caused everything to slow down. And it was very apparent that she didn't really know too much, or, and it made me very nervous, the entire process through.
Yeah. And that's, again, slows down the process because they don't know what they're doing. And then if you have to send the loan, what they call general processing through SBA, it can add another 3-4 weeks, especially if the government shuts down, like we know happened. So that's a huge thing. So when you are looking for an SBA lender, you need to ask them, are you PLP? How long does it typically take you? Ours, I usually say 60 days from beginning to end, from the time that the borrower accepts our term sheet and we start moving into underwriting. You can count on 60 days, to close. We might be able to shorten that a little bit, but that's typical. And as long as everybody's doing their job, if we we have a list of questions for the seller, we have a list of questions for the buyer, and they don't get it to us, somebody's traveling, whatever, that can add time to it. So as long as
Yeah.
everybody's doing their job.
And to add to that time frame, like I usually tell buyers and sellers, you're looking at 90 days. From the time we go under contract, not work with you, but from the time we go under contract till the time we close, because like you said, your 60-day clock is ticking from the time they sign that term sheet.
Yeah.
Now, typically what we do, we get the business pre-qualified, by an SBA lender. We take it to the market. The buyers that, before they put the contract, we accept the contract. How we run my practice is that they have to get pre-qualified themselves by an SBA lender, make sure that they're qualified. But then we go under contract, they still have to get a term sheet. Now we have to match the buyer with the business, make sure it's a good match, make sure the business or the bank's okay with it, that you're okay with it, Lynn. And then you send over the term sheet and the buyer signs off on the term sheet. So you could burn through, let's say 2 weeks there. And then what you said, I think is very important, how quickly everybody gets back. And, for the buyer, there's a lot of stuff the buyer needs to do. And there's a lot of stuff the seller needs to do too. But the buyer, there's a ton. And with the seller, they're trying to run a business, so you can sit there as a seller and say, yeah, I'm going to get everything over very, very quickly because I want to, get this transaction closed as soon as possible. But when you're actually trying to work, do your regular job every day, and then the bank's asking for this, there are those delays. And every time there's a 1 or 2 or 3 day delay here from the buyer, 1, 2, 3 day delay from the seller, it adds up, so.
Yeah, it can get frustrating.
I don't want to sugarcoat it because it is a process.
It is,
but it is a powerful tool.
It is a very powerful.
So you have to understand.
It's a pain in the butt, but it's
it is. So it's a good segue into what I think is probably the most important part of an SBA transaction is probably the underwriting. So if you're a seller, from a seller's perspective, which is how we'll talk first, let's talk about how a seller can prepare their business for SBA. What type of business is going to qualify as an SBA lender?
Right.
Or product.
The best advice I can give a seller is run your finances clean. Don't run all kinds of personal stuff through all the different expense categories, because much of that is very difficult to prove. The typical add backs, as you guys know, it's depreciation, amortization, interest, owner's salary, and
strange one-time expenses.
Yeah, just like
odd things.
Sometimes they had to put a new roof, or they had to put a new roof on, which happens every 20 years. And we had to spend $50,000 on this roof. Those things we can look at. But running your kids' cell phones, through the business.
Your mortgage payments.
Yeah,
going to Lowe's or Home Depot and using your business card for personal things.
Or Costco and buying your groceries and then trying to say, well, of this Costco bill, 20,000 of it was our personal groceries. You can't add those back. Now, they may be doing it. You may be able to show the buyer that they're doing it, but it's not something that's going to
a lender's going to accept
cash flow. Right. And again, we're cash flow lenders, right? So we have to prove everything. So best thing for a seller to do is run your books clean. Just run clean for the last 2 or 3 years.
I am so glad you said that, because we are always preaching that on the podcast, is that exact thing. So I'm glad you're saying that.
Yeah.
Absolutely.
And when you're not, seeking financing or getting your business pre-qualified, you may have substantiation for your add backs that a buyer may trust.
Yeah.
And you could get a deal done outside. But when you're talking about a government-backed program, even if you have the substantiation and you have the backups and you have a nice general ledger saying all of these charges from Amazon were for me,
right? They
were not for the business. It's not going to fly with an institution and working through SBA. So, you'll look at them. There's been several times where I've sent it to you and, you'll do a little litmus test with underwriting and credit and making sure this we can pass, maybe this we can't pass. But, when I send you over a recast of a business financials and almost every single line item on their tax return has an add back, that's where I know as I'm sending it to you, this one's maybe not going to qualify.
Yeah. Right.
It happens pretty often.
Exactly.
Yeah. And I think with that too, with the, with the add backs too, as a business owner out there, because sometimes I'll have a business owner who will say, well, I don't want to do the SBA then. I don't want to do the SBA. And the thing is, if your business is going to sell between that $750,000 and $2 million mark, it's if you don't if you're not going to use an SBA loan, you are cutting your buyer pool greatly, greatly, greatly. I mean, you're actually putting your business in a position where it's probably not going to sell.
Or you're going to have to sell or finance it.
Yeah. And then on Carey's part too, when he was talking about buyers, like, we have to worry about the lender, and, maybe the buyers will accept some of those add backs, but buyers get turned off when they're looking at it at an add back sheet and there's tons and tons and tons of expenses. They don't want to sit there and due diligence going through a general ledger. Oh, $20 here, $43 here. And don't be, I had a business a few years ago. The wife of the owner spent almost $100,000 a year on expenses that were under $100.
Oh God!
And it's like, there's nobody that's going to go.
But she had her Excel spreadsheet with all.
They gave me like a general, and they had highlighted all. I'm like, I just looking through it. I'm like, nobody's
not going to happen.
Not going to happen. We got to just wipe all that out.
Yeah.
So
like it doesn't exist.
So if I'm a business owner and my awesome broker says that I should go try to get qualified for SBA financing, what type of documentation should I expect to have to provide to get qualified?
This is a buyer.
Seller.
If
it's a seller, yeah.
Well, we got to pre-qualified for the seller.
Yeah, but I'm saying when a seller submits to get pre-qualified and they're giving the information to us, what are you looking at?
Yeah, the tax returns. We have to work off of the tax returns for
How
the
many years?
Last 3 years. Now, we're at the end of 25, right? So that nobody's filed their 25 tax returns yet. So we would get 22, 23, and 24 because we need all tax returns. Then we get the year-end 25. Sometimes lenders will look at it, and if 25 is so much better than 24, we'll say, well, okay, we get 25 was a growing year, but you're going to need to file your tax returns before we can close.
Mm-hmm. So if it's a big jump from a previous year.
If it's a big jump. So we'll basically get the tax returns, and then we'll get your recast.
Mm-hmm.
That's key. So I take the tax returns, I look at the recast, we'll run my numbers, and that's when I say, okay, yeah, this looks good or not. Now, if they carry receivables, we're going to want to get the full financial picture. So we want aging of receivables and payables. We may want to get a list of the equipment that might be conveyed with the business. But up front, the major pre-qualifications are the tax returns and your recast and interims. So like if we're in the middle of June in 2026, we're going to want 22, 23, 24, 25, 26 tax returns, and then whatever 6-month interim in 2026.
And I'm going to point that out because I was just talking to a business owner the other day. It was a pretty big business. I mean, not real big, but they were doing, I don't know, $4 or $5 million in revenue a year. And he only gets and he's been doing this the whole time since he's been in existence. He only does his financials at the beginning of the year. He goes down, takes the box of stuff, gives it to the CPA, and he's looking to sell in a couple of years. And I told him, you got to start right now. You got to hire a bookkeeper or an accountant that's going to do your books monthly because the buyers are going to want to see, when the buyers are looking at your business, they're going to want to look back and see monthly P&Ls for 2 or 3 years. And the bank is going to want, interim financials. And you guys need what? The P&L has to be within 60 days when we close?
Yeah, 90 days,
90 days?
Of getting the SBA authorization. Yes.
Yeah, okay.
Yeah. But so that's a good point is we run into that, where the sellers we're in June or July and we're like, we want the interims, and same thing. Well, I don't do them at the end of the year. Well, they have to go do them.
Yeah.
Because we have to have it. So best thing is if they don't want to do it monthly, at least do it quarterly, because then you can usually fit that 90-day period within the orders.
So from a buyer perspective now for SBA, what type of you talked about experience, right? I mean, this is a business transaction, so you want to see relevant business experience.
Right.
If I'm a buyer and I'm not well capitalized, I don't have a lot of cash, but I have great experience, can I get it done, or vice versa? Let's talk a little bit about the buyer side for qualification.
You can, depending on the loan size. Lenders would be looking, us in particular, I can talk from our standpoint, is we want to see some liquidity left after you put your money in, right? So you've got we ask for the personal financial statement. Personal financial statement comes and the borrower's got $20,000 in savings. But they tell us they're looking for a $2 million loan or $2 million purchase of that.
The math's not math.
That's not going to work, right? So they've got to tell us where they're going to get their money from. You can get money from gifts. So if you don't have if you've got the great experience, everything else about you is just fits this business perfectly, but I don't have the $200,000 to put down on this $2 million business. You can gift it. So you can go to family, friends, and get the money gifted that way. You can pull in minor investors who might be investing. We don't want to see them invest all the money that's going in, but you can get some investors and keep them under 20%. So there's no guarantee. So you can get it that way. You can borrow your funds as long as you have outside income to service that debt. So let's say you can go get a HELOC. You can do that, but if all of your personal income is going to come from the business that we're financing, you can't borrow it. You can borrow from in retirement funds. There's the ROBs, the rollover. We don't suggest people use rollovers unless they're putting more than $100,000 into it because it's an expensive proposition. But you can liquidate, retirement funds. So there's different ways you can get your cash injection. But once you put your money in, again, we don't want to see you putting every dime that you have, because let's say something happens in the business down the road, 6 months, and it wasn't quite what you thought, but so you're a little short on cash. Where are you going to get that from?
Or maybe it's not even, the business's thought is what you thought it was, but like unexpectedly something happens. A major piece of equipment goes out and you have to buy it.
Right.
Yeah.
So two things.
You guys do provide working capital with the loan too,
exactly. Right? Yes. So we will kind of calculate, what we think the working capital need is for the first 3-4 months, and we'll roll that into the loan
and provide that to the buyer at the closing table. So they put 10% in, they get some working capital back and the business. I'm sorry to cut you off, Carey.
Well, I mean, on that point, an illustration on a deal we worked on together, it was a $600,000 transaction. I think there was $100,000 of working capital. They brought $60,000 to the table for their 10%.
Mm-hmm.
And they bought a business that was an absentee owner making about $200,000 a year. So again, cash out of pocket, $60,000. Day of closing, they get $100,000 working capital and purchased a business netting $200,000. They literally were in the positive buying the business by about $40,000.
Yeah.
They got $40,000 on the positive to buy a business that absentee owner running was generating $200,000. That is the power of SBA right there.
That is really the power. But the buyer has to remember that that money is working capital. They'll need that until the funds start flowing in from billing and things like that. But it's great. I love those kind of scenarios.
It just opens up such an incredible opportunity for so many people that are chasing the American dream of owning a business.
Absolutely. Because there is, the thing is, there's a lot of, not a lot, but I hear from buyers and sellers a lot of SBA loans, SBA, I've heard, they're a pain. They are a pain. Gosh, what a great thing we have in this country. I mean, my friends in Canada that are brokering, I mean, it's so much harder to close transactions, and it makes the seller be able to sell the business much easier. Buyers are able to buy businesses they wouldn't be able to buy otherwise. I mean, we're so lucky to have the SBA in this country.
Yeah. And as we were talking before we started this, it allows for even higher dollar amounts of businesses to be sold, right?
Yes.
So, before, like you're saying, if somebody had to pay cash and they just have $300,000, they're going to buy a business for $300,000. But now we can sell that business that's $3 million with the $300,000. And so that opens up your world too, and the seller's world who, may be trying to figure out how they're going to get their business sold.
And it's night and day what a $300,000 business is and a $3 million business. If you're a buyer and you're looking at $300,000 businesses and $3 million businesses, it's night and day, and day.
So it sounds great from a buy side perspective, but let's talk about not necessarily the shortcomings of it. Because I mean, if you're getting a loan, there's going to be some type of collateral, but a buyer buying a business through SBA is going to have some personal guarantees that they have to make.
Yes.
You want to talk on those?
Yes. So anybody that owns more than 20% of a business is required to personally guarantee. Now, sometimes there's somebody who owns less than 20%, but they're bringing more of the money in, or they have a little bit more experience than the guy who's got 80%.
Mm-hmm.
The banks can require that guarantee. It's not a requirement, but SBA SOPs require anybody that it owns more than 20% to guarantee the loan. There was another thought that I was going to have. Oh, for the collateral.
Yeah.
So here's an example of one that I have going on right now. It is a CPA firm buying another CPA firm. They specialize in a certain area. It's a $4 million loan that we're making. There is absolutely no collateral. They work, though there's no office. Everybody works remote. It's a national firm, so they're all over the country. Their employees are all over the country, but they all work from home. So $4 million total airball deal, and we're closing that deal.
Wow!
So
awesome.
that is it's an example of the benefit of SBA.
So most buyers, though, they'll have, when they do a personal guarantee, it's going to come in the form of collateral, typically of.
Right. Okay. So that's a good point. So if you're a buyer, you're guaranteeing this loan. It opens up your personal assets to collateral. The one that I just talked about, the guy doesn't own a house; he rents. So there's no equity in personal residence. If you do have equity in personal residence and we are undersecured, which most of them are, then yes, that opens up to cross collateralization of that asset.
And let's go into this because I run into this too. A lot of times I see buyers have multiple investment properties as well. So how does that affect?
And that
collateral?
opens that up as well.
All the way up to the loan value.
Up to 85% loan to value.
Okay.
So you'll have to have collateral in some form up to 85% of the loan that's given.
Only if you have. You don't have to have any collateral.
Have it. Only if you have it.
If you do have that collateral, they'll take the lenders will take the collateral up to 85%.
Right. Which, the SBA and says, well, yeah, we're going to give you this great loan and these great terms.
We need to be safe.
Yeah. I mean, if you've got this collateral, you either have the option to go borrow against the collateral.
Mm-hmm.
Let's say you've got a $2 million house and you owe $300,000 on it. You can go get an equity loan, take that money and go buy the business, or you can get an SBA loan, but we also need to use that as collateral. Now, again, if you don't have the collateral, that's not a reason to decline the loan. So people who don't have, a lot of equity in residences or investment properties or anything like that, you can still get an SBA loan because the SBA says you can't decline the loan because you don't have sufficient collateral.
So can a buyer just not disclose that they?
Well, you're getting a federally guaranteed loan. I would think that's considered fraud and probably a felony in this.
Yeah.
Absolutely. Let's talk about the mechanics of the deals. So one of the things that you're looking at is your ratios, right? So let's talk about what an average ratio is and what that means in a deal.
So debt service coverage ratio is what we look
DSCR.
for. And again, we go back to the cash flow, right? So we will figure out, we'll just take the net income. We do all our add backs, figure out the seller discretionary earnings. Then we will calculate what the new owner, what they need to cover their personal needs. And let's say it's $100,000. So I get a seller's discretionary earnings. I'll subtract $100,000. Now I know what's available to service the debt. We've got our debt. We divide it into it, and we're looking at the debt service coverage ratio. Most lenders, you're looking at 1.2, 1.25, on a deal that might be $700 to $2 million. The higher up you get and the more uncollateralized the loan is, a lender might be looking for a higher debt service coverage ratio. SBA, I think, says we need to be at least a 1.15. So if you're above any of that, you're within the SBA guidelines. But then again, we talk about the lenders overlaying their credit.
Yeah.
Yep.
So we as a lender, if we're looking at, let's talk about this $4 million total
CPA
airball deal, we're looking at more of a 1.71 to 2 times debt service coverage ratio to get comfortable with that because we just have no collateral. So the weaker the deal, kind of the stronger, I say weaker the deal from a collateral standpoint, the stronger the debt service coverage you probably want.
Got it. And when we talk amortization, like we said, 7A is typically 10 years, 504 is 25 years. Let's talk about rates.
Yes.
So, you can go get private money and you're going to pay quite a bit.
Yeah.
If institutional capital is available that's non-SBA, it's still typically pretty expensive. But what does SBA look like? And I know it varies, but
the SOPs tell lenders that you can charge prime plus 3. That's your max. That's a lot. Yeah, I don't know.
What's prime today?
Yeah, prime is 6.75. So,
went down quite a bit.
It's gone down. Yeah. So on a business acquisition, no real estate, you're probably at prime plus 2.25-ish to prime plus 2.75, just depending on the lender. So it's at the lender's discretion. So whatever the lender is willing to charge, they can. Some lenders will charge prime plus 1. Some will charge prime plus 2.5. Just depends on how probably the strength of the deal.
Strength of the buyer.
And the strength of the buyer.
I need to interrupt on this, Lynn. Like I anybody out there listening for SBA loans, do not, you might be talking to 3 or 4 different lenders. I would not pick your lender that you're going to use based strictly on the interest rates that they're charging, because I don't know. You need to go with when it comes to SBA lending. I do a lot of deals that the buyers are acquiring the businesses with SBA lending, and there is a big variance of BDOs. BDOs are bank development officers. That's what Lynn is here. She's an A+ BDO.
Mm-hmm.
I mean, she has been doing this a long time. She knows what she's doing. She's extremely knowledgeable, and she gets deals done. I have had to work with other BDOs that buyers found these lenders on their own, and I had a couple deals last year where the lender dropped the ball 2 months into the transaction, and we had to start all over again.
Mm-hmm.
And even if the deal goes through, it's like pulling out your hair. You got to find an A+ BDO that's with a great bank that has a great closing department. I think those are the 3 three legs of a stool that you have to look at. Shopping and saying, oh, this lender is going to be a quarter point cheaper. You want to get across the finish line and close the deal.
Yeah. And find out if they have a separate division. I always say this, they got to have a separate division to they don't, instead of doing it all under their business banking group. And how much did they close last year? So you've got some bankers out there that are saying they do SBA, but they may have closed $50 million, of SBA loans versus, 200, 300, 400,000, million in loans. So, find out what their shop did, because that's going to tell you how aggressive they are and how well they can get the deal done.
Yeah. Great.
I have something here. SBA loans, the good, the bad, and the misunderstood. Let's bust some myths. A common myth, SBA loans take forever. Now, they're not quick.
No.
But they're also not 9 to 12 months, like some people say. So average transaction,
60 days.
60 days. How about these are only for small startups?
Totally false, because as we were just talking about, the
off cash flow.
Yeah. Yeah.
How many startups have cash flow?
Right. Exactly. Yeah.
I can agree with this one. Too much paperwork. It's a lot of paperwork.
It's a lot of paperwork.
I remember walking to my first SBA deal at a closing table, and I'm used to seeing a little stack, and this stack was this big.
Yes.
There was a lot of signatures going on.
Yeah.
But, for a government-backed and guaranteed loan, there's going to be paperwork.
And the problem is there was somebody who sued the bank because of this or whatever, and then now they had to create another document. And then now these documents date back, creation of them date back probably to the 1950s when SBA started.
Yeah.
And the paperwork's gotten bigger.
It has.
Since 30 years ago I was doing this, and you're right. Now it's much larger.
We're just sitting at the closing table, just shooting the shit sometimes and just watching papers fly back and forth.
It's the buyer that has to sign all that paperwork. The seller doesn't have to sign too much.
Not too much.
So
paperwork from the SBA.
This is one thing on here that SBA is only for first-time buyers.
Yeah.
That could not be more opposite. I mean, I'm seeing, smaller private equity groups or, independent sponsors and institutional buyers, professional buyers still levering SBA products.
Absolutely. Absolutely. And I I've made several additional loans to prior borrowers, who bought something through SBA. 2 years, 3 years down the road, they find another business that they want to buy. They'll
We're trying to do one of those right now.
Exactly.
What's the cap on that, Lynn?
Well, $5 million
Okay.
is the cap on the 7A. However, we've got a couple of options. One is the pari passu. So last year I did a barbecue restaurant in Texas. The loan was $6.4 million. So I did a $5 million 7A and $1.4 million conventional
loan.
That's called the pari passu. I did that twice last year on 2 different deals. But there is the option of, if you've maxed out your $5 million and now you're going to go buy another business that is in a totally different NAICS code, industry code, you get another $5 million.
Oh, I didn't know that.
So yeah, so we're able to kind of use that program again.
So let me get this straight. So, the cap is $5 million.
Yep.
So you could go out and you could buy a business for $1.5 million. Then you go out and you could buy 2 more businesses as long as it stays under that $5 million, unless you do the pari passu.
Right.
And then, but if you use a completely different code,
if you're buying a business
code
in a different industry,
yeah.
and you're totally setting up a different corporation, you can get another $5 million.
I didn't know
So long as the buyer can qualify for it.
Yeah.
And the business that they're buying.
Yep. So when is the SBA a wrong option or a bad option?
Well, when the business isn't showing sufficient cash flow. So the seller, as we were talking about, has been running everything through their business and we can't prove that. That would be a bad option. I would say, if it's a much larger transaction, the ones that are over 5 million, 10 million, those 20 million, you're probably looking at venture capital or
private equity groups, private equity players. And
yeah.
Another myth, you can't buy a business with seller financing and SBA financing.
Totally incorrect.
Yeah.
As a matter of fact, as a lender, we kind of like seller financing.
Yeah.
We like the fact that the seller is engaged in the transition of the business.
How often do you see an SBA deal with seller financing?
Quite often.
Yeah.
Quite often.
More,
I would say
at least 50% or above.
I would say at least, maybe even 75. Depends on the size of the transaction.
When will you require seller financing or the seller to participate?
If we really are uncomfortable with the borrower, our borrower going into the transaction and just wanting that little extra help that the
make
seller,
sure the seller's going to stick around.
Yeah, that the seller's gonna stick around. The seller's not going to go off and steal some of the clients, even though they sign a non-compete. There's sometimes you can get around those kinds of things. Just to strengthen the deal a little bit, if there's some add backs that we did that we might have done, but we're like, let's just get the seller engaged a little bit more here.
Well, and the buyers love it too, right? It's an endorsement from the seller and the confidence that they have in their business in most cases.
Exactly.
I try to I got to say, I tell the sellers, my job is to try to get all your money on the day of closing. And that's how I feel. I hate owner financing. So telling the sellers out there, if you're thinking about selling your business, we'll fight for you on that. Unless we run into a situation, because you and I are working on a deal right now, actually, that we have to do some owner financing. And I don't want to get involved in the whys because it's confidential between the buyer and the seller, but and the seller's okay with it. And I think it's a good move because of the situation. But typically I try to get the seller all their money on the day of closing. But sometimes you have to do what you have to do to make the transaction happen.
Yeah.
I think an important thing that we should include in today's conversation is some of the rules that can make or break a deal. There are some guidelines from SBA that people may not be familiar with. So there's rules around seller financing, like we're talking about, owner occupancy, equity injections, affiliations. You want to talk about maybe some of these?
Right. So on a business acquisition, as we talked about, there is a requirement of a 10% of the project. So the project is the purchase price, working capital, closing costs. So that is an absolute for a business acquisition. Now, part of that can come from a seller carry.
Yep.
but at 5%. Now, the 5% though would be on full standby for the life of the loan. So, a lot of sellers are not going to want to sit there and wait 10 years to get their money.
Yep.
So a lot of times that's not going to work. Let's see what else that is the absolute, one of the most absolute on a 7A requirements that SBA has on the business. Now, if it's an expansion, again, we're working on this one deal now. Same company, same industry. Company owns a business. They're going to go buy another business in that same industry. Then that 10% requirement is no longer needed. So it can be an expansion. So expansions you can finance 100% of.
We did one of those last year with you.
Yes, exactly.
Another thing I guess I would say is, I don't want to call it right of entry, but when you're doing a deal, there's always contingencies when we're selling a business, right? You have financing contingency if there's financing involved, franchise contingency if there's a franchise involved, your due diligence contingency. What about the landlord?
Oh boy. So
I don't know if we want to open up Pandora's box here.
That's one of the requirements is that if you're in lease space, if the business is operating in lease space, they have to have a term of the lease as long as the amortization. So we got a 10-year amortization. They have to be able to stay in that building if they want to for 10 years. So we got to go to the landlord. Let's say your seller's got 7 years left on his lease. We've got to renegotiate or negotiate another 3-year option to get us to the 10%. Then we've got to go to the landlord and ask them to give us what's called a landlord waiver, which basically says if the business goes under, if the borrower defaults, the lender has the option to come in and get our collateral.
Assets. Yeah.
A lot of landlords don't like to sign that. And, we've got a waiver form. It's not set in stone. So there are some, there's some leeway in that the landlord, if they're not happy with one part of it, they can potentially change. So that's one SBA document that actually is negotiable. Many of them are not, but that's one that is. But sometimes, and we've had deals that have blown up because a landlord wouldn't actually even approve the new owner. It wasn't one of mine, but my counterpart in Miami had one where there was a hairstylist kind of place, and it did well. It was a large loan. The new buyer came in. Landlord wanted to see the personal financial statement. The landlord wasn't happy with the personal financial statement, didn't think it was strong enough. And he's like, no, I'm not going to approve this person for the lease.
I wish I could say I haven't experienced that myself.
The whole deal fell apart.
Oh my gosh.
So landlords can tank a deal.
Yeah.
I think it's important too. Can you talk a little bit about the transcripts from the seller, the tax transcripts?
Yes.
I think it's important to point that out.
That
Very
is
good
a
point.
requirement that the lender submit the request to the IRS. It's either a 4506 or an 8821 form. And the seller sign it. And we need to get the last 3 years transcripts from the IRS. Then we need to compare them to the tax returns that were given to us. And the majority of the time they're right. Sometimes we find some, little oddities in there that
I had about 2 years ago. We did that. Transcripts came back. They were way off.
Yeah.
And it turned out that when he filed for 1 year, and when he filed his tax returns that 1 year, he had two companies and he had swapped the EIN number.
Oh.
So it delayed closing by like 2 or 3 months. We had to do the CPA had to do addendums and all kinds of stuff. But,
yeah. You can't close when you have those kinds of things sitting out there. So, a lot of times it's not fraud. Most of the time.
Yeah,
it's
this
not
guy
fraud.
didn't mean to.
Most of the time it's just, they filed their tax returns for a sub S corporation, but they never filed the original document that elects that. So then they got to go back, fix that with the IRS. That can delay. Now that can cause a deal to be delayed 6 months.
Yeah.
Because you're dealing with the IRS.
They move super fast.
They move. They're like really fast, aren't they?
So you have to stay pretty in tune with what's going on because there's a ton of changes that always happens, and it's underwriting standards or just policy. Is the SBA lending getting tighter or smarter? Or both?
Under the new administration, it got tighter, but lenders were happy about that because the prior administration had loosened up a lot of it. They had taken away a lot of the exacts, and it was kind of gray area. And lenders don't like gray area when it's for SBA, because if we make a loan and we kind of interpret this one area that's in the gray one way, make the loan defaults, we go to the SBA and say, hey, we need your guarantee. The SBA could say, well, wait a minute, you didn't make a prudent credit decision here, even though it was in that gray area, and they can decline or repair your guarantee. We don't like that. Lenders don't like that. We want to know exactly what they want. So with the new administration came in, then they tightened it up again. It wasn't tight. It was just brought back to the old SOP standard.
Yeah.
So, but you're right. They change it all the time. I mean, especially lately, it's been like whiplash. Things change. Don't know if you heard the latest about now we can only make loans to U.S. citizens.
Yeah.
Before it was you could do it with green cards and U.S. citizens.
Isn't that weird that you and I were just talking, because I have a deal right now that we were just talking about, somebody from overseas getting 5% because the company does work overseas. And then a week later, that new rule came out. I'm like, well, thank goodness we didn't go down that avenue.
Right. Right. Yeah. Well, I have one that got totally, can't move forward with it. We were starting to go into underwriting, and the guy has a green card and can't do it, which is really, for 30 years, we've been able to do loans with people who have green cards, and now you can't. So you're right. They changed the rules, and we just have to stay on top of it. And, you make a loan based on what the rules are.
But it's not like it was during COVID. Oh my gosh. Remember during COVID? It was like, there'd be one thing on Tuesday, we changed by Thursday, and by the following Tuesday, it'd be something else. And it's like, holy cow.
They were so awesome. I almost bought a business through SBA during it just because of the flexibility of the terms.
Yeah.
But
they did it. They actually, I think they did a really good job during that. I know things were changing crazy, but I think we needed to it during that time period.
I closed a couple deals during COVID that were SBA deals.
Good.
So what should buyers, I know you don't have a crystal ball. What should buyers expect in the next 12 to 24 months with the SBA program? Do you think it's going to be more encouraging? Is it going to be the same?
Oh, yeah. No, I think it definitely is. I mean, the last 5, 6, 7 years, the SBA programs have just skyrocketed. I mean, more and more and more people are using SBA. I don't see it every once in a while. There's little tweaks, and like we just talked about, but it's a great program. The amount of loans are going up. The volume of loans are going up. I think the mainstream exposure to what SBA is, I'm getting a lot of people that will reach out to me to acquire a business with their SBA pre-qualification letter, to start. Yeah. Where 5, maybe 7 years ago, you didn't see that really.
No, you had to talk people into doing it more often. Yeah.
Couple closing questions. So, what's the number one thing buyers should do before talking to a lender? Get pull together their tax returns, pull together their personal financial statement, make sure that their credit is, 680 or above. Get their resume pulled together. And watch this podcast. Do a little bit of research. I mean, there are a lot of rules, but I mean, it's a mainstream product. You can quickly understand if it's for you or not. Sure. Yeah. And then I love this one. What kills more SBA deals, bad businesses or bad preparation? Bad preparation, I think. Yeah. Yeah. I mean, there's a lot of really good businesses out there, but they're not prepared to sell. And I mean, we try to alleviate some of that, working to prepare a business owner, whether they're 1, 3, 5 years out or ready to go now. Yeah. Well, and then also too, sometimes you go into a letter of interest, right? So, somebody's going to look at a business, you give okay, I think I like this. Here's a letter of interest. Now you got to go get the purchase contract solidified, right? Mm-hmm. Sometimes I've seen where the deals fell apart because the negotiating in the purchase contract got so intense and so far off from what the letter of interest was that the whole deal fell through. Mm-hmm. I had one like that last year. So that's another part that I think
should be done sooner rather than later is the purchase contract.
Can I add my input? I think one of the biggest problems I see as a business broker is picking the wrong BDO. And I'm not just saying that because you're sitting here. I mean, that's the biggest problem I probably struggled with last year was buyers picking lenders that they found on their own that weren't up to par.
Yeah.
And you got to get a BDO that's at the top of their game, in my opinion.
And then most of that is because of pricing, as you talked about, interest rates. They want to try to get the lowest interest rate. And then just going to their banker that they know, even though that banker may not be the best SBA option.
And typically the big box ones aren't.
No.
I remember I had pre-qualified a business with you, brought the business to you, buyer planned to go with you, last minute shopped it, went somewhere else. It was delayed 6-7 months.
Yep.
And they called me back and they said, I got a great rate, but that was not worth it.
Yeah.
And I don't think your rate was that much different.
No.
But and we're really scratching the surface here of SBA. There are so many more things we could talk about, but we wanted to kind of keep it a little bit surface level, but give you enough information on buy or sell side if you're considering leveraging the SBA product. Hopefully this was some good information for you today. I encourage you to call Lynne Singletary of 44 Business Capital, a division of Beacon Bank. You've been a wealth of information, not only today, but for my whole career.
Yeah.
Literally, as soon as I came into this industry, I started working with you. I've learned so much. You answer the phone, you know what's going on, and you get shit done. So very thankful to have you on Boss Talk today. We appreciate you coming out.
It was my honor to be here. Thank you.
Awesome.